One retirement year can look normal at home, but very different on a tax return. Mark and Elaine may feel like their retirement income is about $155,000. But one unusual tax year can look closer to $315,000 on paper. And 2 years later, that older tax return may help explain a higher Medicare premium notice. 2024 tax return to 2026 Medicare premium decision. Before you react to the premium amount, look for one thing first: the year Medicare is using. The notice may feel like it is about today, but the income behind it may come from an older return. So the real question is not only, what is my income now? The better question is, which tax year is Medicare actually reading? That one question is the heart of the 2-year Medicare lookback rule. And for higher income retirees, that lookback can lead to IRMAA. IRMAA is an income-related adjustment that can add extra charges to Medicare Part B and Part D premiums. This video is not about one rental sale, one Roth conversion, or one investment gain. It is about the rule behind many Medicare premium surprises. In a moment, we'll unpack Mark and Elaine's numbers, then build a simple 3-part map you can use before a tax year closes. The goal is not to avoid every taxable decision. The goal is to understand the trade-off before the year is finished. Quick note: this is education, not personalized advice. So talk with a qualified tax professional, planner, or Medicare professional before acting on anything here. Let's start with the problem. Then we'll come back to the map. The first problem is that retirees often use the word income too narrowly. For IRMAA, income may include wages, interest, dividends, capital gains, pensions, IRA withdrawals, Roth conversions, rental income, and business income. So a household can feel retired, spend conservatively, and still show a large income number on a tax return. That is especially common when one-time events land in the same calendar year. With the look-back rule, a past tax return can feel more important than today's lifestyle. The tax return does not say this was a one-time event, a cleanup year, or a thoughtful retirement decision. It records the income, and Social Security may later use that number when determining IRMAA. Social Security usually uses IRS tax information from 2 years earlier to decide whether IRMAA applies. Let's return to Mark and Elaine's numbers. Their normal retirement income might be about $155,000. Then, one unusual year arrives. They realize $85,000 of stock gains. They also have $40,000 of work income. And they complete a $35,000 partial Roth conversion. None of those choices has to be wrong. But together, the example tax return can move toward roughly $315,000. That can be frustrating because nothing about their day-to-day life may feel dramatically different. They may be living in the same house, spending carefully, and still seeing a higher Medicare bill later. And Mark and Elaine are only one version of the problem. Another household may not sell property or make one dramatic move. Maybe one spouse retires, but a final bonus, deferred compensation, or consulting payment arrives in the same year. On paper, that transition year may look much higher than their normal retirement life. Then 2 years later, Medicare may still be reading that transition year. The household may feel retired, careful, and lower income now. But the premium decision may be tied to an older return. That is why the look-back rule matters. It is not about one type of income. It is about which year Medicare is reading. One-time income, transition year income, and retirement year income can all matter if they land in the year Medicare later reviews. That is the disconnect many retirees miss. Medicare may not see the story behind the income. It may simply see the number. The problem is not bad decisions. The problem is crowded decisions. Too many good moves in one year can create one expensive-looking tax return. A crowded income year can make a retiree feel punished for being organized. A second problem is that tax timing and Medicare timing are often handled by different people. A tax professional may focus on the tax return, an advisor may focus on the portfolio, and a Medicare professional may focus on coverage options. But IRMAA sits right in the middle of all three conversations. If nobody connects the pieces, the retiree becomes the messenger, and that is a hard job to give someone who is just trying to retire well. The household needs one shared calendar, not three separate planning conversations. Another mistake is waiting until the Medicare card or premium notice arrives. By then, some of the income years that matter may already be closed. Once December 31st passes, that tax year becomes history. You may still have options later, but there may be fewer options than before the year closed. And this is where many retirees make one more assumption. They think an appeal can fix every high-income year. In some cases, a qualifying life-changing event can support a request for a new review. Retirement, work reduction, or certain income losses may matter, but not every high-income year is treated the same. A planned income event may not be the same thing as a true income loss after retirement. That is why planning early usually feels calmer than sorting through paperwork later. Documentation helps, but timing often helps even more. Couples also have one more layer to watch. Two Medicare timelines can sit on top of one household tax return. One spouse may be starting Medicare while the other is still working, consulting, selling assets, or receiving delayed income. So one person may say, "I am retired," while the household return says, "This is still a high-income household." That mismatch can feel personal if nobody warned you ahead of time. Here is the look-back map I would want Mark and Elaine to build before assuming the bill is wrong. The IRMAA Protection Map has three parts. Map the years, project the income, and coordinate the decision. Part 1 is map the years. Put the tax years and Medicare years on one page. Write down ages 63, 64, and 65. Then add the tax years that may be used for premium decisions. For example, if 2024 income may affect a 2026 premium decision, put both years on the same timeline. That one picture can make the look-back rule feel much less mysterious. Once you see the years on one page, the rule becomes much easier to discuss. The timeline helps you see whether this year's income may show up in a future Medicare decision. Part 2 is project the income. Do this before the large taxable move, not after the tax return is filed. MAGI stands for Modified Adjusted Gross Income. In plain English, it is the income number used to determine whether IRMAA applies. MAGI is not net worth, and it is not how wealthy you feel. It is a tax number. Ask your tax professional or planner for a rough projection before the year is almost over. You do not need a perfect forecast. You need enough clarity to know whether you are building a risky income year. Then list the income spikes before they happen. The plain question is this: does all of this need to happen in the same calendar year? Sometimes the best move is not avoiding income. It is spreading income across years with more care. The goal is not to make the tax return look small at any cost. The goal is to understand the trade-off before choosing the year. If a Roth conversion is involved, size it. Do not guess it. If a capital gain is involved, ask whether the timing, the size of the sale, or other income in the same year should be reviewed. If retirement income dropped, keep documents that show what changed and when. Part 3 is coordinate the decision. This is where planning becomes practical. Separate one-time income from recurring income before deciding what to do next. A temporary spike may require timing and documentation, while ongoing income may require long-term budgeting. Coordinate both spouses on the same page. Write down both birthdays, Medicare start dates, Social Security timing, pensions, work income, and planned taxable events. This is where many couples find the missing piece. One household income number can affect one or both Medicare conversations. Prepare an IRMAA folder before there is a problem. Keep retirement letters, employer separation notices, pension changes, tax projections, Social Security letters, and tax professional notes together. If a review is needed later, organized paperwork can make the process less stressful. Schedule a pre-December income review. Review realized gains, planned conversions, charitable giving, business income, and any income you still control before year-end. December should not be the first time your household says the word IRMAA. If IRMAA still makes sense after the review, budget for it and move forward intentionally. An expected cost feels very different from a surprise notice. For Mark and Elaine, the better move is to trace the notice back to the tax year being reviewed before assuming the bill is wrong. That does not mean they avoid every taxable decision. It means they choose the order with more care. Before every large taxable move, ask this sentence. Will this income affect my Medicare premiums later? That question can turn a surprise into a planned trade-off. Now let's put this back into Mark and Elaine's situation. They stop reacting to the bill and trace it back to the tax year Medicare used. If the notice says tax year 2024, they start by asking what drove the 2024 income. Then they separate what can be changed from what can only be documented. They compare a crowded income year with a cleaner sequence across multiple years. They still make thoughtful retirement decisions, but they stop letting every decision land in the same place. That is better sequencing, not fear, not avoidance, just better timing. The same financial decision can create a different result when the order is chosen carefully. If you are 63, pull your tax return and circle every item that could repeat, grow, or spike. Look for capital gains, IRA distributions, Roth conversions, rental income, business income, interest, dividends, and one-time payments. If you are 64, look at last year and this year before you make another major income move. You may not be able to change the past, but you can still prepare, document, and make better choices going forward. If you are already on Medicare and received an IRMAA notice, do not ignore it. Read which tax year was used, check whether the income is accurate, and ask whether your current situation supports a new review. If the income was planned, learn from it. If your life truly changed, document it. Either way, the answer is not embarrassment. The answer is better information. High income by itself is not the problem. Uncoordinated income is where surprises often begin. A strong retirement plan should know which income year Medicare may look back to. Please like this video if it helped you understand the Medicare Lookback more clearly. Liking the video helps more retirees find this before a surprise Medicare notice lands in the mailbox. Subscribe to Tom's Medicare Blueprint for calm, plain English guidance on Medicare, IRMAA, and retirement income planning. This channel is built for retirees who want straight answers without scare tactics. And comment the word Lookback if you want a follow-up checklist for this exact Medicare income issue. The word Lookback tells us you want practical examples, not generic Medicare talk. Before you go, remember the order: year, income, decision. First, identify the year Medicare may review, then estimate the income, then decide what move belongs there. You do not have to master every IRMAA bracket to protect yourself. You just have to ask the right question before the income year closes. Will this income affect my Medicare premiums later? This is Tom's Medicare Blueprint, helping you plan Medicare simply, clearly, and with care.